Good morning and welcome to the Ashoka India Equity Investment Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to Investment Director Ayush. Good morning.
Thank you, Alex. Good morning, everyone. Thank you for joining us for this call today. My name is Ayush. I'm an Investment Director and a co-PM at the Ashoka India Equity Investment Trust. For those of you who are not familiar with the trust, let me take a couple of minutes to share a quick background about the history of Ashoka India Equity Trust. Ashoka India was set up in 2018 by White Oak Capital, an asset management house founded by the former chief investment officer at Goldman Sachs Asset Management. Today, White Oak is amongst one of the largest foreign institutional investors investing into India, and Ashoka India Equity Trust is a part of the flagship India equity strategy that the White Oak Group runs. When the trust launched in 2018, it launched with a fairly differentiated value proposition in the UK trust market. Three important things. Number one, we said we will charge zero management fee. So the fixed management fee, we set that to zero. And we said we'll only charge performance fee, and that too over a 3-year period, and that too on outperformance over and above the benchmark, which is the MSCI IMI India index. And we also said that we will have an annual redemption facility at NAV, so that investors who want to get out, they can get out at NAV, which acts as a robust discount control mechanism. We're close to 7 years now. And during these 7 years, since the launch of the trust, this is how it has performed. The table on the left captures the performance of the trust. Few things before I go into the numbers. First, all of the numbers that you see are in sterling terms. These are net of performance fees. These are net of all taxes. And these are also net of all unrealized provisions for taxes on unrealized capital gains. So these are net performance numbers that the trust has delivered since its inception in 2018. Now, starting at the bottom, you can see since the launch, the trust has compounded net of fees at 14.7% per year, compared to 8.7% for the index, with an annualized alpha of north of 6% per year, or 600 basis points, making it one of the not only the best India trust, but also compared to other long-only India-dedicated funds would be amongst the top of the peer group. Then you can see every calendar year how the alpha has been. In 2018, the launch year, 250 basis points of alpha, followed by 740 in 2019, 1300 in 2020, 1600 plus in 2021. 2022 was a rough year for the trust, and it was the first year of alpha drawdown since launch, where the trust trailed by 578 basis points. Then again rebounded fairly strongly in 2023 with 600 basis points, and 24 with 866 basis points. This year again is turning out to be a bit of a tricky year, both for the markets. The trust has been able to, it's just about treading water, trailing by a 0.4% compared to the benchmark. So all in all, fairly strong, consistent track record since the launch of the trust. The underlying reason why the trust has been able to do so well since its launch has got to do with a very focused investment culture on the team, which is built on these four key pillars of having the right investment philosophy, having the right team, the right portfolio construction approach, and the right process around that. Now, I'll go through each of these as we speak about the strategy, starting with the investment philosophy first. The shared investment philosophy of the trust is that to earn outsized returns, you need to invest in great companies, but then you also have to be very disciplined about the valuation that you're willing to pay for the great companies. So, a great business and attractive valuation, these are the two key pillars of our investment philosophy. Now, the question is, what is a great business? And everybody has a different definition of what they think a great business is. For us, a great business is one that has these three key attributes. Number one, having superior returns on incremental capital, which in turn is a function of the core competitive advantage of the business. Number two, scalability. India is an emerging market. It's a growth market. We want to invest in companies that can be 2, 3, 5, 10 times bigger than what they are today over the coming years and decades. And number three, excellent management teams, excellent entrepreneurs with strong track record of execution and governance. Our team does more than 3,000 meetings every year, meeting companies, management teams, competitors, talking to employees, suppliers, distributors, industry experts to build a holistic 360-degree perspective on these business attributes. And once we've done all of this, it's not sufficient. It's very important to be disciplined about value. So we are very value conscious, very disciplined about what we want to pay up for these great companies. At the same time, focus a lot more on cash flows, economic cash flows, and not just on accounting multiples or PE multiples, price to earnings multiples, EV to EBITDA multiples, which a lot of other peers focus on. There's a proprietary framework to assess valuation. And at the heart of this is assessing value in excess or value creation in excess of the cost of capital deployed in the firm. And at the bottom of the screen, the metric that you see, price to EROIC, which is price to excess returns on invested capital. This is the primary input into our consideration of value. And this allows us to get better insights compared to the traditional price to earnings multiple or EV to EBITDA multiples, which tend to be fraught with distortions, right? And does not allow apples to apples comparison within an industry and also, of course, across industries. The second key element of, or the third key element of the performance culture, and the reason why we've been able to deliver such solid performance has got to do with the quality of the team. So overall, White Oak has a team of 50 professionals across investment research that you see here. Of this, the blue column that you see are India dedicated professionals. So north of 30 India dedicated analysts who are aligned on sectoral lines and drive the deep proprietary research that I spoke about. So it is one of the most well-resourced India research teams that exists anywhere in the world today. And finally, from a portfolio construction approach, everything that I've described thus far has got to do with stock selection, choosing which company to invest in, which management team to back. The fourth key pillar of our culture is a very balanced portfolio construction approach. How do we construct the portfolio? How do we design the portfolio? What are the weightings of various positions over a period of time? And here, the three key tenets of our portfolio construction approach is number one, no market timing. We do not time the markets. Our belief is that it is not only very difficult, it is impossible to consistently time the markets. It is impossible to consistently go in and out of the markets. And we do not do market timing. We're always 100% invested in the markets. Number two, no sector rotation. We do not think sector rotation is a reliable way of generating alpha. It's a zero-sum game over long periods of time. And therefore, we do not take top-down sector rotation calls. And number three, we do not take any top-down macro bets. So no calls on currencies, no calls on commodity, no calls on interest rates. Many managers try to take calls on these macro variables and reflect them in stock picks, which means that many a times a manager's portfolio might be a manifestation of their macro views as opposed to truly bottom-up stock selection. And that's what we're trying to avoid through this portfolio construction philosophy. Putting all of this together, if I dive deeper into the quality of performance, so we noted that in terms of the absolute magnitude, of course, the performance looks good. 14.7 relative to 8.7 since inception, alpha of 600 basis points. But what we are more proud of is the fact that it's a very high quality performance. And before I go there, this is just a quick overview of how the trust has done versus the peer group since inception in 2018. The cumulative returns are 167 versus 31, 52, and 61. For the other three trusts, India trusts in the market, the benchmark has done 81%. And as a result of this, the shares of the trust have on average traded at a premium of about 40 basis points since inception. The rest of the India trust market on average is traded at 12 to 15% discount for most part. Now, coming to the quality of performance. So far, we've discussed the magnitude of performance. A scientific way to assess a manager's quality of performance is to run attribution analysis. And now attribution can be run across multiple vectors. The two most important ways to run attribution are number one, attribution by market cap, and number two, attribution by sector. And in the next two slides, we are going to look at the attribution numbers. So first, attribution by size. So stock selection, you can break down the performance into two parts, stock selection and allocation. Stock selection, to our minds, reflect the skill element, and allocation reflects the luck element in investment decision making. So in a way, in layman's term, this is effectively trying to break down performance into two parts, skill and luck. Skill, as you would imagine, would be the repeatable element, and luck is luck. Okay? So now, here you would see that across large, mid-cap, and small cap, across all three segments, the performance is predominantly driven by stock selection. In fact, out of the total alpha, close to 100% is the skill element, and allocation is negligible, close to zero. So very high quality performance. Secondly, we'll look at the same thing and do a sector attribution. Right? Where is the performance coming from? Which sectors are contributing? Right? And again, you would see that stock selection is positive in pretty much every sector and is also the predominant driver of returns. So out of 157% returns, 151% is coming from stock selection. So almost 97% of the alpha can be attributed to the skill element, and the luck component, the allocation effect, is 5.7 or about 3%. It's a fairly high quality performance. Um, and finally, I'm going to talk a bit about how the portfolio looks like, and then want to jump into the next section, which would be uh, tackling how the Indian markets are looking like, what is the macro setup, and answer a lot of questions that we've been getting from our investors. So first, the portfolio composition. Ashoka Trust has always had structural tilt towards small companies and mid-sized companies, and therefore you would notice that small and mid-cap is the dominant part of the portfolio. At the moment, about 54% of the portfolio is in small caps and about 7.5% is in mid caps. If you add the two, so roughly 60% plus 61% of the portfolio is in small companies, small and mid-sized companies, and about 34% of the portfolio is in large companies. And this is what you would expect to see going forward as well. The rationale to have structural tilt towards small and mid-sized companies is because it is a more inefficient segment of the market. Given our deep on-the-ground presence and the capability to drive differentiated proprietary research allows us to extract outsized alpha from this segment of the market. There is alpha to be made in large caps as well, but given the greater efficiency in that segment of the market, the alpha potential is low. Okay? From a sectoral perspective, again, there are 5 key pillars to our portfolio. Number 1, financial services, which is about 20% of the portfolio. Number 2 is consumption, both consumer discretionary and consumer staples. If you add the two, that's another 20%. The third pillar is industrial companies, which adds up to 20%. So you can see about 20% each in financial services, industrials, and consumption. The fourth pillar is healthcare, which is about 14%, and the fifth one is technology, currently at 7%. So these are the 5 key areas where we currently find a lot of attractive opportunities. Then in the middle, you can see energy and utilities, where there is pretty much zero exposure. So that's one segment of the market where historically we've not really found a lot of attractive opportunities given the investment philosophy and process that we have. Finally, I want to talk a bit about all the performance numbers that you saw has come while owning a large number of investments in the trust. So it's a very granular portfolio, fairly diversified portfolio. Currently about 150 positions across mid-cap, small cap, large cap. From a quality perspective, return on equity is about 17%, and our current expectation is that the portfolio has an earnings growth of about 14%, which is higher than the index at 11%. The return on capital is higher than the index at 15%. And on a cash flow basis, which is the proprietary metric that we look at, the portfolio is about, call it 10% cheaper than the broader market. So slightly leaning towards quality, slightly leaning towards growth, and from a value perspective, about 10% cheaper, which we think is a very good bargain considering the superior quality and growth attributes of our portfolio companies. That brings us to a close as far as the first section is concerned. And now I want to talk about Indian equities. Right? Now, many of you ask us that what is the primary reason why should one invest in India to begin with? Right? And to our minds, the single biggest reason to invest in India is the alpha opportunity. This is a study that was done by Wall Street Journal prior to the pandemic. And what they did here was to look at all the large equity markets to figure out what are those markets where it makes sense to just buy an index fund, and what are those markets where active management still works, and therefore it is better to opt for an active manager. And here you can see that India is the most large inefficient market in the world that exists today, and that, to our minds, is the most compelling reason to invest. Um, that being said, the core, the pillars of, or the fundamental reason, apart from the inefficiency, the argument for or the case for India has always been predicated on these four key pillars. Number one, it is today the fifth largest economy in the world and steadily going to become the third largest as we speak. So on the right-hand side, you can see how India has been climbing the ranks in terms of the scale of the economy. By 2030, it will be the number 3 economy in the world after US and China. So it is a large market, uh, and the fastest growing large market in the world. And with such an economic transformation comes large opportunities to create wealth. Number two, very domestically driven growth, consumption driven growth, attractive demographics, urbanization. All of you are very familiar with this. The third reason, and which to our minds is less understood reason, is the profitability of the corporate universe and the heterogeneity of the corporate universe. And to illustrate this point, let me show you a very interesting graph, which compares the large emerging markets, right? So if you look at some of the large markets like Korea, Taiwan, Brazil, etc., those economies are fairly concentrated in a few sectors. So Korea or Taiwan, it is the semiconductor supply chain and electronics that describes pretty much the entire market. So here you can see Korea and Taiwan, which is on the right-hand side. Technology is 76% of the Korean market. Industrials and tech add up to about 54% of the Korean market and Taiwanese market. On the other hand, you would notice that India is the most heterogeneous market, just from the composition perspective. In fact, it is even more heterogeneous than China. So this is the order of heterogeneity from the most concentrated on the right-hand side. So these are concentrated markets, and on the right-hand side are heterogeneous markets, where no single industry segment is a large part of the market. And which means that there is enough opportunities in various sectors to extract alpha. And this also means that the return on capital is high. So if you see the 20-year ROE, or return on equity, for India is at 17%, which is ahead of most other emerging markets because of entrepreneurially driven capital allocation within a fairly heterogeneous universe. And number 4 is the fact that India today represents a fairly mature democracy and has the institutional infrastructure, by which I mean having a truly independent central bank, having an independent election commission, independent judiciary, rule of law, intellectual property rights protection regime. All of these things are a given in many developed economies like the UK, the US, but it is not a given in most emerging markets. And that's where India really stands out in the eyes of global investors. Now, coming to how the earnings growth of the market and the stock market performance has been since 1991. So 1991 that's when the Indian market started to liberalize, economy started to liberalize, and since then, the index, which Sensex, which is the longest history, has compounded at about 12% in local currency terms. You take out 4% for depreciation, so about 8% in dollar terms. So that is the long-term, really long-range performance. When I say long-range, I mean a 30-year performance, which is pretty good. And on top of that, good active managers have been able to extract sizable alpha, which makes India a fairly attractive market to invest in. Now I want to come to some of the few things. So from a macro perspective, we often get asked valuations for India. We get asked around interest rates, inflation. So that is what we'll try and tackle. First, around valuations. So this, on the top left, you can see the long-term history of multiples. And what this tells you is that India has always been an expensive market. Throughout the last 3 decades, on average, the multiple has been 17.7, call it 18x. So 18x is the history of the last 30 years, right? Which is sort of on the higher side compared to many other markets in the world. And then if you look at the last decade, which is 2024, 25 till today, the average has been about 21 times, right? So let's call it, rounding it up, 21x. And today we are just about that number, 21x. So while in absolute terms, it might look optically expensive to many, compared to its own history, it is pretty much where it has been for the last decade or so. And primarily the reason why it has traded at a premium to most other emerging markets has got to do with the things that we discussed earlier, which is not just being the fastest growing large economy in the world, but also having the mature infrastructure, the institutional infrastructure of a mature democracy, having a very strong return on capital compared to other emerging markets. And then what you also see in the Indian market, and let me bring up that slide, is that compared to many other EMs, India has built the reputation of never having to deal with either a currency crisis or a debt crisis or any sort of political coup. And you can see there are many emerging markets here that show up. Right? Of course, you've got something like an Argentina that seems to be a habitual offender, and there are many other. You would never see India showing up in. So this is a reputation that the economy has built over the last several decades, which again leads to a premium compared to other emerging markets. In addition to that, one should also adjust for the fact that state-owned enterprises have a much lower weight in India compared to other emerging markets. So government ownership of stock markets is different in different economies. So for example, China is about 25% of the market is owned by the government. On average in emerging markets, 19 to 20% is owned by the government. And India, only 11%, 10 to 11% is owned by the government. Now, why these numbers are important is because everywhere in the world, government-owned companies trade at a discount to privately run enterprises. So here on the right-hand side, you can see the PE multiples for government companies is here, the light blue graph, and private or non-government owned companies is here. So naturally, any economy that has a higher proportion of government-owned companies ought to trade at a discount mathematically, right? So this is, again, a very important adjustment that needs to be made when you look at India's multiples. Now, I want to talk about some of the macro indicators. And to that end, we'll first look at interest rates and inflation in the economy. since the pandemic, what we've seen is many developed market economies, namely US, Europe, UK, have faced higher inflation. So there have been tremendous inflationary pressures in most markets. In India, if you see, inflation has been fairly benign since the pandemic. So this is 2020, and since then, inflation has remained in the 4 to 6% range. So fairly benign inflation. As we speak, inflation is at the latest print was sub 2%. Uh, Expectation is inflation should be in the 3 to 4% range over the next uh, couple of years. And the benchmark interest rates in the economy is 5.5%, which means that there are real interest rates of about 200 odd basis points on a rolling forward basis, right, which is a very attractive real interest rate spread. And that also means that the central bank has enough ammunition to cut rates as and when required to boost the economy. So the first indicator, which is around inflation, interest rates, looks quite healthy. Number two, the real economic growth. Economy continues to chug along quite well. Consensus projection is in the ballpark of 6.5%. That is the real expected growth in the economy, which is very good. Then the fiscal deficit. India, being an emerging economy, runs a fiscal deficit. And since the pandemic, what we've seen is strong glide path to 4.8%, going down to 4.4. So the fiscal discipline has been very strong. And the current account balance, which historically in 2000, post the global financial crisis, for a few years, India did have a current account problem. But of late, you would notice that for the past decade or so, current account has been pretty much in a very comfortable range. So on all the four parameters, which is inflation, interest rates, real economic growth, fiscal discipline, and the current account balance, on all the four parameters, the country is looking quite solid as we speak. Then, to judge the health of an economy, it is important to look at the health of the banking system. And one of the most important variables to look at in the banking system is how much of the balance sheet is non-performing assets or the credit cost in the economy. The higher the number, the worse the health of the banking system. And here you would notice that the Indian banking system, the credit cost peaked in 2018, right here. That's the number. So at about 3% of the loan book, that's where it peaked. And since then, we have seen a structural decline. So from 2018 till today, over the last 7 years, the non-performing assets in the banking system have gone down structurally. And therefore, the health of the banking system is in pristine shape. Then we look at the leverage in the economy, which is how much is the leverage on the balance sheet of corporates. And here we measure the top 500 companies, their debt to equity. And here you would see that since 2015, there's been almost a decadal deleveraging cycle at play, which means that the corporate sector has been paying off debt, has been reducing the debt on the balance sheet, and has the capability to borrow and again relever as and when required. Right? As they do productive capital expenditure, you can relever the balance sheet. So from a supply perspective, now the first two graphs have to be seen in conjunction. The banking system has the capacity to lend, and the corporate system has the capacity to borrow, right? Which creates a fairly good condition for the economic cycle to chug along. Then the third thing that we measure is the health of the real estate sector. Right? Real estate is a very important sector of any economy. In fact, buying a house is the biggest capital investment that any household does in its lifetime. Here we look at the inventory in the system, and the lower the number, the better it is. Currently, the inventory in real estate is about 18 months, so 1.5 years to liquidate the entire inventory. Real estate market seems to be doing quite well. And private sector has been announcing a lot of projects. You can see a clear rise in the announcement of new projects, which could potentially mean that we could see a leveraging up cycle in corporate India. So on most of the parameters, most of the macro indicators, what we're seeing is that the economy looks to be in a very good shape as we speak. And finally, there have been a lot of questions um, around tariffs and what does it mean for India and the world. Uh, and after this, we'll open up for questions. So first of all, we want to see in absolute dollar terms, where does the economy stack up compared to other large markets? So this graph captures the trade surplus with the US, which is essentially the deficit that US is running with all the countries. And here, as all of you know, China runs the biggest trade deficit with the US at just about 300 billion. Number two is Europe, that runs a deficit of 267 billion, followed by Mexico and Vietnam and Taiwan, which run deficits of ranging from 75 billion to 175 billion. And then you've got Japan, South Korea, Canada, and then finally, this is where India stacks up in absolute terms. So in absolute terms, India's trade deficit with the US is fairly small compared to other regions in the world. What is more important to look at is the sensitivity of these of rather the trade with US, how sensitive that is to economic growth. And to measure that, the metric that we look at is exports to the US as a percentage of GDP of the country. And here, this measure tells you the real sensitivity. So countries like Vietnam, Taiwan, Thailand, you can see have fairly high double-digit sensitivity, right? 10% to 25%. For India, that number is 2.2%, right? So before looking at the tariff percentage, we need to look at what it is going to be applied on. So what will be the tariff? It impacts only 2% or 2.2% of the GDP, so to speak. So the point here being that, yes, tariffs are high on India, but the economic impact is far lower because of lower trade intensity. India is primarily a domestic driven economy, and the dependence on global trade is far lower compared to many other economies, in contrast to economies like Vietnam, Taiwan, that are very heavily dependent on trade, global trade, and that to trade with the US. And therefore, lower tariffs are always good, but in the broader scheme of things, India is far more resilient to tariffs than what one might believe by reading the headlines in the newspapers. So to sum it up, the key message that I want to leave you with is, as we speak, India presents a fairly compelling value proposition. It is the fastest growing large economy in the world, a very inefficient economy, inefficient stock markets that allow for active alpha generation. And over the last 12 months or so, we have seen the markets take a breather. Well, it is impossible to say what happens, but looking back, most of the times, the best time to invest in markets has been after some bit of correction and pullback, what we've seen over the last 12 months. And Ashoka India Trust, with what we believe is the most shareholder friendly proposition, which is namely no fixed management fee, only performance fee, that to measured over an index over a 3-year period with annual redemption facility at NAV, presents a fairly compelling value proposition to access, to my mind, arguably one of the most attractive equity markets anywhere in the world. With that, I'll take a pause and happy to answer any questions that you might have.
That's
I can
great,
see
Ayush. Yes,
the
that's great. Thank you
questions
very
started.
much
So
indeed for your
begin.
presentation. If I may, thank you, ladies and gentlemen. Please do continue to submit your questions using the Q&A tab on the top right corner of your screen. And while Ayush takes a few moments to review those questions submitted today, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via our investor dashboard. Ayush, if I may just hand over to you to read out the questions where appropriate, and I'll pick up from you at the end. Thank you.
Perfect. Thanks. Now, thank you everyone for sending the questions. We already have a big queue that's building up. So let me get cracking straight away. So the first question is, what risk management processes are in place to manage concentration within small and mid-cap holdings, especially given their high volatility? Thank you, John, for that question. Very good question. So let me try and address that. So the first thing, as you know, we do invest a lot in small and mid caps, and here you would see we have got 54% of the portfolio in small caps, 7.5% in mid caps. The first thing that we do from a risk management perspective is to make sure that no single investment is a big proportion of the portfolio. So here you would notice that we've got 113 stocks in small caps. So we've got 113 small cap stocks totaling up to a 54% position, which means that on average, a small cap stock is only 0.5%. That is the average exposure that we have to one single small cap. We have got 18 mid cap stocks totaling up to 7.5% position. Yeah. So that again tells you that we have less than 0.5% position in a mid cap stock on average. So the point that I'm trying to make is the position sizing is very granular in nature. Right? We probably have the most granular risk profile compared to any other India trust in the market. Right? And ultimately, the biggest risk to our minds is not really understanding our investments. So not knowing what you're investing in is the biggest risk. That's what creates permanent loss of capital. And our teams, our 30 plus research team that is based on the ground in India, conducting a very extensive due diligence program, ensures that we understand our investments better than everyone else. And then finally, we're very nimble with position sizing. So we do not get married to our investments. If a particular investment is not working according to our thesis, if the thesis breaks, we change our view. We are happy to take corrective actions, move on to other attractive opportunities. So being very nimble from a position sizing perspective is another vector of risk management that has held us in very good stead throughout. And finally, I want to show you the risk management at work by this showing you the slide. So what you see here are the top 10 contributors and the top 10 mistakes since we launched the trust. So on the left-hand side, the top 10 contributors, the biggest winners, and on the right-hand side are the worst mistakes. Few things. Number one, you will notice that there are no superstar stocks in the portfolio. There are multiple stocks that are done really well, right? Multiple stocks that have contributed 1,000 to 1,500 basis points. Number two, they come from very different segments of the market. The first one is a tech stock. The second one is a financial services stock. The third one is a specialty chemicals business, so on and so forth. And number three, and most importantly, you would notice that the alpha or the money that we have lost in our worst mistake is far less than what we have made in our 10th largest winner. So we lost 470 basis points of alpha in our worst mistake since the launch. But we made 800 basis points in our number 10 winner. And that is real risk management work, not allowing any mistake to burn a big hole in our portfolio performance, being very nimble. And when the facts change, we change our view and our position sizing. So I hope that helps to answer your question, John. Moving on to the next one. This question is from Miles. How have your earnings estimates for the portfolio changed during the year? Great question. Thanks for the question, Miles. Uh, so, like I described earlier on this slide, the earnings expectation for the portfolio is in the ballpark of 14 to 15%. And that has remained fairly stable through the year. We have not seen any meaningful change in the earnings estimate for our portfolio companies. It has changed for the index. We have seen some bit of downgrades there, but our portfolio companies have remained fairly resilient in terms of their earnings trajectory. The next question is, can you please discuss the available universe? And how has this evolved over the life of the fund? How do you expect it to change in the future? And question on stock turnover and average holding period. Okay. Now, thank you for that question. So the first one is the investment universe. And to address that, let me bring up the slide on investment universe. So see, India has about several thousand listed stocks, yeah, of which about approximately 2,000 stocks are actively traded in the market. And for us, the investment universe typically tends to be anything that is more than $500 million. We do invest even below that, but typically the cutoff is around $500 million, which leads us to 800 odd companies. Right? So and this number keeps changing. Today it might be closer to 900, given the markets have rallied some over the last few months. Now, step one is to weed out the bad apples. So we screen out companies with poor governance characteristics. We avoid companies that have weak economic characteristics. And then we look for the positive attributes, which is to arrive at a list of companies, 250 odd companies that we think are great businesses, and then apply the value framework to arrive at the most compelling combinations of great business at attractive valuation. So that is how I would describe the universe and the stock selection criteria. The next question is from Stuart. He asks, can you give us a qualitative overview of the regulatory focus on the stock market? Example, does the stock exchange try to encourage certain behaviors on listed businesses? No, thank you for that question, Stuart. So the way I would like to answer this is from a governance and compliance perspective. At White Oak, we do actively invest in other emerging markets, including China, Korea, Taiwan, Brazil, Mexico, all the large EMs, and therefore have built a good sense of how governance practices vary across these markets, right? And everywhere in the world, there are forms of misgovernance that exist. At White Oak, at Ashoka Trust, we have built a fairly sophisticated framework of assessing corporate governance practices. And what you see on the screen is just a snapshot of the framework that we use to assess corporate governance in any company. Right? In general, I would say that the governance standards are very good in the emerging market context and are constantly on an improving trend. Stock exchanges enforce high degrees of transparency. So in terms of any material development, there are very strict regulations around disclosures, timely disclosures, around disclosures if they do meetings with investors, any update on the corporate side, etc. And from our perspective, the way we think about governance is the first thing that we need to do as investors is to avoid the bad apples. The recipe to earn outsized returns is to make sure first that you don't invest in disasters, right? And therefore, over the last 6 years, what we've been able to do is avoid corporate governance disasters in the country, and that has been a important driver of the alpha that we've been able to generate. And a very important point that I want to leave you with here is that you need to build specialized capabilities on the team to be able to assess governance. And here, let me take you to the slide on the team. And you will notice here that there are these green bars here. And the green bars denote people who are focused on ESG. So the team is led by a former investigative journalist with Bloomberg who runs our ESG and governance analysis process. So we've got a specialized team who focuses only on corporate governance. And every investment that we do is independently evaluated by this ESG team, and they run an in-house scoring of all the investments that we do. And this team has helped us to, like I said, avoid a lot of governance disasters in the country. Right? So you need to build these specialized capabilities to navigate, so to speak, the landmines that exist in all stock markets everywhere in the world. Yeah. I hope that helps to give you some context on how we think about governance and what we do from a portfolio perspective, Stuart. Thank you for your question. The next one is, has household debt risen much over the last decade, and where does interest expense as a percentage of disposable income for that area stand relative to its history? Okay, so household debt has not risen too much, nothing that worries us. Interest expense as a percentage of disposable income has gone up. Households have increased leverage, but it is far below what you would typically see in developed economies, Miles. So yes, it is on the rise, but nothing that worries us. It is par for the course as economies become more prosperous, as more and more people come into the financial system. They typically do lever up to buy a car, to buy a new house, to spend on their wedding, for education. So all sorts of financial products become accessible to them, and naturally you wouldn't expect household debt to rise as an economy prospers, as an economy progresses. Okay? Miles has asked another question, which is there a UCITS that mirrors this strategy? Yes. So there is a UCITS vehicle as well, which is called the Ashoka India Opportunities Fund, which is the UCITS variant of the trust. It's a daily liquidity product. I must, however, explain the key differences. So while the similarities are there, the key differences versus the trust are: number one, the UCITS is an open-ended daily liquidity vehicle. It is a pure fixed fee vehicle. There is no performance fee there. It is only fixed fee, and has much lower exposure to small and mid caps compared to the trust, because it is a daily liquidity vehicle. And finally, the last key difference is that in the trust, we can do up to 12%, which is going to 15% of the trust in pre-IPO opportunities. So the trust has also benefited through our pre-IPO strategy. We typically look to invest in companies that have, that are 1.5 years away from IPO, getting in early, when it is still undiscovered by the markets. The UCITS cannot do pre-IPOs. So these are the few differences that exist between the trust and the UCITS vehicle. Thank you, Miles, for the question. The next one is, what could be the key reasons why investment thesis may not play out? Well, see, there are always risks in any investment that you make. There is no free lunch anywhere in the world. And similarly, investing in equity, investing in an emerging market like India also carries a lot of risks alongside. Yeah. Let me see if we have that slide here ready on risk. So first of all, as far as our strategy is concerned, these are some of the situations, some of the environments that might lead to the strategy and the trust underperforming. Number one is when poor governance companies in aggregate outperform the good governance segment, right? And that often happens in every market in the world. And the trust has a tilt towards superior corporate governance. Number two, when pockets like commodities, energy, utilities, tobacco, these are the segments of the market, as you saw earlier, we do not have exposure to. So when this segment outperforms, that becomes a risk to our investment strategy. Number three, when government owned companies tend to do really well, given our investment philosophy, we run large underweights on government owned businesses, right? And that is the third potential risk factor or headwind to this strategy. And number fourth is when large caps outperform small caps very sharply in a short period of time, right? Or differently put, when mid caps have a fairly weak performance relative to large caps. So these are some of the situations when our strategy has historically faced headwinds, and in the future as well, uh, would be a risk factor from a strategy perspective. Finally, how do you measure and incentivize the analyst team? And what are the specific skills you look for in an analyst staff turnover? A great question. Thank you for that one. So let me tile back to the team, to the attribution slide, okay? Because this ties back to the question on how do we incentivize our analysts. Remember, investing is just like any other super competitive sport, right? There is an immense value to high quality talent. It is very important to retain them, incentivize them so they are motivated. At White Oak, we think we have a very meritocratic investment philosophy and compensation philosophy. Um, the way we measure our analysts is how you would measure our performance as investors. What we focus on is stock selection alpha in every sector. So, for any analyst, and our analysts are, our teams are aligned on sectoral lines, every sector team would be judged on the stock selection alpha that they generate per unit of capital deployed in that particular sector. So, for instance, the financials team would be measured on the alpha, stock selection alpha, which is this 30.4 divided by 25.4, right? So this metric is a very important, and this would be measured on trailing 1 year, 2 year, 3 year, 5 year, 10 year basis on multiple trading time periods. And this is the single most important element that goes into performance evaluation for our analysts, and that's how they're incentivized. With that, I think we've been able to answer most of the questions. I would like to thank everyone who has joined us today for their for joining us today, and those of you who are existing investors, thank you for your support, and look forward to speaking with all of you again next quarter. Have a great rest of the day.
Fantastic, Ayush. Thank you very much indeed for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Ashoka India Equity Investment Trust PLC, we would like to thank you for attending today's presentation, and good morning to you all.